Investment banking is one of the most profitable fields in the financial industry. For the year 2021, investment banks alone contributed a whopping amount of 280 billion US dollars towards the United States economy. Not only that, but if we talk about the financial assets controlled by just the top 5 investment banking firms, you will be amazed to know that they value around almost 36 trillion US dollars, which is almost 30% greater than the gross GDP of the United States itself. These factual figures depict monumental success of investment banks, and if just the sound of the money gives you a tingling sensation, then investment banking is the domain worth exploring. So, what exactly is this investment banking? Why is it so lucrative? And how does it make these enormous amounts of bucks? Well, before we touch upon these monetary queries, first let's go back in time to see how it all began. From the early 19th century, commercial banks in the US performed the functions that we now associate with the investment banks. But during the period of the Civil War, everything just suddenly changed. The US federal government needed more money to finance their military initiatives. However, they had no bright idea about how to raise these substantially large amount of pennies. That's about the time a man named J. Cook, a Philadelphian financier, stepped up. In 1861, this guy laid the foundation for the first ever American investment bank aiming to help the federal government. That means the US government became the first ever client of the investment banking. Governments wanted money to fund their multiple projects, but why would someone invest their hard-earned money without any sort of security? Right? That's where the idea of releasing securities, or what we commonly call bonds, came into existence. Governments started issuing bonds to gather investments, build infrastructure, and more importantly, to support its growing economy. Initially, what investment banks did is they bought all the bonds from the government and sold them to the private investors for profit. Today, they function in pretty much the same way itself, just with the different sets of parties involved. Now, this might lead you towards another question. From where those billions of dollars are pouring into these businesses? Well, the business model is quite straightforward. Investment banks purchase the assets that hold monetary values, otherwise known as securities, and sell them to private investors for a certain amount of fee. This whole process is termed as underwriting. Now, why would these third parties want to take the help of a middleman like investment banks and spend money doing so? Why won't they deal all that by themselves? The perks of making this kind of a deal is that the middleman is responsible for the risk of distributing all the securities. If they are unable to locate new investors, they will be forced to keep those securities. To intuitively put this forward, investment bankers are the risk takers who would take all the risk for secure transactions between investors and clients. But risks are not only entitled to the investment banks. Commercial banks also take risks. However, there is a huge degree of difference between those risks. The commercial banks deal with the common individuals and small to mid-sized companies, giving out smaller sums of money like personal loans, business loans, vehicle loans, home loans, etc. These financial firms benefit from the interest they charge on the lump sum of the lent money. Whereas investment banks deal with the huge companies and high-risk startups, acting as a bridge between corporations and investors. In this process, they can earn huge amounts in fees, as there is a adage, higher the risk, larger the profits. All of this sounds great and astounding, but let's be honest. Investment banking is not a fantasy simulation like the Disneyland. This industry has its flaws. You guys have heard about the financial crisis of 2008? If you haven't, it was one of the worst financial disaster ever to happen in the economic sector, which led to the Great Recession in modern times. It was called the Subprime Mortgage Crisis 2008. Here's what happened. In 2001, the federal government increased the bank's liquidity, simply the amount of cash the bank can hold, while decreasing the federal fund rates. The federal fund rate is the interest that the governing Federal Reserve banks charge to other financial institutions for lended sum of money. This enabled the banks to give as many loans as possible without even doing thorough background checks. And of course, commercial banks could not give the loans endlessly. So, to make room for new borrowers, they sold their old loans to the investment banks. And investment banks sold those debts by packing them with new wraps to the wealthy investors, without disclosing how insecure those loans were. At the time, it did not seem risky. Borrowers, investors, commercial banks, investment banks all made profits. It was like a heavy rain of profits. But after every huge heavy rain, there comes tsunamis and floods. And that's what exactly happened. Suddenly the interest rates started rising and people started losing their assets. This panic spread everywhere and the US economy literally crumbled down on its knees due to this banking collapse. The big reason for this was the irresponsible trading done by the investment banks. But does it make the investment banks a villain? And will we be better off without them? The answer is no. The subprime mortgage crisis was one of the crises that happened in the history of banking. There are many market crashes that happened in the past, and many will happen in the future as well. But what is worth remembering is that without these very investment banks, the US government couldn't have built their first railroad projects, mines, highways, and IT companies. Many companies could not have received huge and risky investments to revolutionize the world with their technically sound products. Many technologies, visionary projects could not have seen the light of the day without any support from investment banks. So now, the only question is, what does the future hold for investment banking? It is crucial that you understand. The world will always need companies that could drive innovation. Those innovative companies will always require huge investments. And also, the people with the money will always look out for opportunities to invest and savor their future, which clearly depicts the need of our middleman, that is investment banking in this world. And hence, you should believe that investment banking is here to stay and it will. More increasingly, if you are looking to build a career around this field, then as a beginner, you could be entitled to the salary of $140,000 in the United States of America, where in India, you can expect the average salary of around 12 lakh rupees, which could go also up to 70 lakh Indian rupees. And the best way to climb up the ladder of success and gather lucrative offers to learn the intricacies of investment banking operations. Intellipaat has recently hosted an advanced certification in investment banking operations. The curriculum of this program has been designed by industry experts to acquaint you with everything you need to know in order to build a career in this astounding field. So, what are you waiting for? Go ahead and start exploring the wonders of the economics and the financial world. On that note, we have come to the end of this session. If you like this video, a thumbs up would be really appreciated. Also, don't forget to hit that subscribe button and the bell icon to never miss interesting and captivating educational updates from Intellipaat.